for me to introduce you to you, Billy. He has been a certified financial planner here for 20 years in Florida, and he is going to go over how the tax structure in retirement might affect you tonight. Just a couple of housekeeping rules, of course. Make sure to help yourself to refreshments. The bathroom is outside and to your right. If you have any questions, we will certainly be here to answer them, and we hope you enjoy your evening tonight. Thank you.
Thank you.
All right, sorry, I'm recording this, so I have my phone almost fell off the table. So everybody pull out your packets. You may have already seen it. Everybody has a $100 bill in their packets.
All right.
Looks good. Very good. I've got one.
So pull out that $100 bill. Don't have one? Well, we'll get you one. You can have mine. I'll get you another one. You mind giving me another one? So by the way, that $100 bill, if you'll notice, look at it pretty closely. It's not spendable. And if you end up trying to spend it and the cops show up at my place, Guido, the guy who gave me those $100 bills, I'm going to have him come visit your house too, okay? So, but anyway, we're going to do something fun and get this thing started with a little bit of interaction with the $100 bill. Thank you, Ms. Shimp. So what is this essentially? It actually represents more than a $100 bill. What this really is it's your retirement. It is what you have saved for. It's what you've sacrificed for. It's what you have built over a lifetime. And this is pretty daggum important because this is what is going to help you move through the many years of retirement that you have available left on this earth. And so we have to make sure that this $100 bill works to your best advantage possible. But the problem is that there's some things going on in this world that want your $100 bill as well. And by the way, what's the name of the program tonight? Taxes in Retirement?
Yeah, taxes.
All right, so everybody hold up your $100 bill. That's right. Now keep holding it because you're going to have to do something to it here in just a second. Take about 30% of that $100 bill and rip it up. Here's the taxes.
Yeah.
All right. Now, when it comes to taxes, what are some of the things that we're getting taxed on? We'll take the smaller portion. All right. What's some things we're getting taxed on in retirement? Social Security, absolutely. Social Security can get taxed. Go ahead and rip a piece of that $100 bill up. All right, what's something else that's getting taxed?
Pension.
Pension's getting taxed, absolutely. Pension's getting taxed? What else?
Housing, cars.
Yeah.
Sure. So basically just general life, there's some taxes going on, right? But basically all the income in retirement. So all of your income that's coming in during retirement is typically getting taxed, correct?
Yeah.
All right, what's something else that's eating away at our $100 bill in retirement?
Inflation.
Inflation, absolutely. Good point, absolutely. What's something else?
Insurance.
Insurance, absolutely. Insurance in the way of what?
Medical.
Health insurance and medical costs are rising 3 times the amount of inflation. So go ahead and take a nice chunk of that $100 bill and throw that on the ground. What's something else? How about bad investment results? You think that eats away at your retirement at all?
Definitely.
Go ahead and rip another piece off. And by the way, the kids decided they want to move back home and they want their inheritance today. So go ahead. So now, our $100 bill that we started with, this is what we have left. Well, you might as well call it zero at that point, right? So what we're here to do tonight is to maybe shed a little bit of light on some things we can do to keep that $100 bill as intact as possible. Now, we're gonna do the best job we can. It's not gonna be completely intact, but we're gonna do the best job we can to keep it intact. But we're gonna touch on all of those things. I know the title of the program is Taxes and Retirement. What you're gonna see this evening is a lot of changes that have happened this past year in the tax laws. Some of it's not gonna apply to retirees. And I'll probably skip, I'll probably run right through, retirees that need child tax credits are probably not too many in this world, okay? So I'm probably gonna skip through some of that pretty quickly. And then I'm gonna move on to some additional items that I have added to the presentation that really come home to retirees and things they need to talk about. So, by the way, so tonight is educational, it's not advice, all right? Now, you're gonna have an opportunity to get some advice, and I'll touch on that later in the presentation, but tonight's presentation is really just educational purposes. Now, so let's start out, so when it comes to the United States tax system, 50% of tax filers pay basically 100% of the tax, and 50% of the tax filers pay zero tax. And if you happen to be in the top 10% of tax filers, you're paying about 70% of the taxes. And so if you're wondering who the top 10% are, how about if you make $138,000 a year in taxable income, that puts you in the top 10% of tax filers. So even though you didn't think you were rich, guess what? According to the tax filing system, you're rich. All right, so there's been some major tax changes in legislation over, actually, this is a year-old presentation, so it's actually 11 years. But if you'll notice, there's all kinds of tweaks and additions and subtractions always going on with the tax system. And so, like I highlighted at the bottom, taxes are always changing. So one of the things that's happened in this last Tax Act is that they have made some changes that were the business tax changes they call permanent. And I'll touch on that in a second. And then most tax changes affecting individuals actually currently expire after 2025. But so what's going on currently with individual filings will resort back to 2017 after 2025. Now, anything that says that this is a permanent tax change, let's go back one slide and pay attention to that highlight again. Taxes are always changing, okay? So even though something says it's permanent, well, it's permanent during this administration, this Congress, the people who are currently making those decisions and calling those shots today is permanent. But as soon as those people change in Congress and presidency, that is all subject to change. So just understand permanent does not mean permanent when it comes to the tax system. So what has changed? Well, marginal tax rates have actually gone down. Sorry about that. Long-term capital gains and qualified dividends, there's been some tweaking there, but that's essentially pretty much the same. The alternative minimum tax has actually changed considerably as far as who ends up qualifying for the AMT. And also there's been some small changes in the kiddie tax. The orange bars here represent the old tax marginal rates, and the green represent the new marginal rates. So as you can see across the board, there have been some changes to marginal rates. They have dropped down across the board.
What does marginal tax rates mean?
Great question. Marginal tax rates are, so we have what's called a progressive tax system. So whenever you make a certain amount of money, and once you hit a certain threshold, you get taxed at a higher rate.
Different margins?
That's right. So once you hit a different level, then that's your next margin.
Gotcha.
Great question. And here's the tax rates in a more graphical form. For single filers, there's actually, with the tax law changes, there's actually been I guess, once you get over $157,000, there's a significant amount of single filers who actually, their taxes have increased under the new tax law. I don't know how well you can see that in the back, but the green line represents a lower tax rate, and then the orange line represents the higher tax rate or the old tax rate. So depending on where you fall into that income level, you may actually have an increase or a decrease. For married filing jointly filers, actually pretty much across the board, except for these poor souls that fall into this little square right here. Those people are paying more in taxes, but pretty much across the board, everybody else is paying lower taxes when they're married filing jointly. For long-term capital gains and qualified dividends, if you'll notice, so basically for single folks, anything up to $38,600 for married filing jointly. So this actually, by the way, this number is incorrect on the slide. It's correct in your book. This is actually $78,500 if I'm not mistaken. But anyway, the numbers are correct in your book. But this represents the zero capital gains tax rate. So if you are making less than that, then you are paying zero capital gains. And then you'll see in the chart, I won't read all those numbers off to you because you can easily see those. But anyway, those tax rates have pretty much remained the same. What's changed in capital gains is your taxable income, not your marginal tax bracket. So if you're hitting a certain tax bracket before, then you were going to be charged a certain capital gains rate. Now it actually, the benchmark is your actual income. Does that make sense? It's not the bracket, it's actually your income number now. On the AMT, I don't think I've ever heard anyone explain exactly how this works very well. And frankly, I don't think I ever want to hear it because it's very complicated. The thing that you should take away here is that it's dropped from 5 million people having to pay the AMT to about 200,000 to pay the AMT. So they've done some significant changes there. A couple other factors to consider when it comes to taxes. The 3.8% net investment income tax has pretty much remained the same. There's no significant changes in that. The kiddie tax, the one thing that has changed with the kiddie tax is that instead of, does anyone or everyone understand the kiddie tax? Basically, the idea is that parents are trying to shift income to kids so that so the kids use a lower tax rate versus the parents. And so the kiddie tax is in place to make sure parents aren't trying to shift income to kids to avoid paying taxes. Well, now they've shifted from charging at the parents' rate to actually trust in the state rates, which are actually less friendly than the parents' rates. So that actually is a significant difference when it comes to people trying to avoid those taxes. So really you have three major takeaways here. You have marginal tax rates are generally lower. You have pretty much the status quo when it comes to long-term capital gains, as well as the 3.8% net investment income tax. And the AMT is still available and still around, but it's significantly dropped for a lot of Americans that would be affected by it. Another significant change that you find in the new tax law is that they have significantly raised the standard deduction. And they also have reduced the opportunity for itemized deductions. So the standard deduction has virtually doubled for the most part. Let me find, and then also they have completely done away with personal exemptions. So here you have the example. You have a married couple. They had a standard deduction in the old tax law that was $12,700. Each person got a $4,050 personal exemption. So they had basically a total deductions and exemptions of almost $21,000. So what the new tax law has done is they simply raised the standard deduction, done away with the exemptions, and you actually get more of a, basically a discount on your taxes because of it. The challenge with getting rid of personal exemptions, it accounted for your kids as well. And so, as you can see here, the old tax law was giving, for a family of 5, was taking into consideration the kids. And so this is a significant difference. However, you will see here in another couple of slides that the child tax credit has also increased. So it actually has significantly changed, actually for the better. They've just basically kind of moved the shell game a little bit, if you will. It moves it towards child tax credit instead of the exemptions. So some itemized deductions that have improved under the new tax law. They repealed the limit for high income earners. So if you have very high income and it makes sense for you to itemize deductions, they have repealed that ceiling. You also have a lower medical hurdle for those expenses. However, it does return back in this year in 2019. The higher deductibility cap for charitable contributions as well. The downside itemized deductions, miscellaneous itemized deductions have gone away, as well as casualty and theft losses. Any questions so far? Home mortgage interest. So this became a hot topic. They have actually lowered the acquisition debt opportunity from $1 million to $750,000. And they actually have also done away with deductibility of home equity loans or home equity lines if you use it for something other than acquisition debt. So let's say, for instance, you already own a home outright and you wanted to go buy a second home. If you could actually use a home equity line or a home equity loan on your current home to go buy a second home, and that would actually qualify for deductible interest expenses. If you decided to take that same money and go sail around the world, well, that doesn't qualify for acquisition debt of a home. So there would be no deductibility on that. Does that make sense? Yes, sir.
One of my understandings of that, you could only spend your home equity money on your own home. I didn't, that's interesting on the acquisition. Okay, I'm glad of that.
Okay.
I've done just that.
Okay.
But I was told it was not deductible. I can only decide if I did improvements on my home. I can
That
deduct
certainly
that.
qualifies. Your own home
Yeah.
improvement absolutely qualifies because you are improving your home.
My accountant guy never said anything about acquisition. That's good.
Well, and so my big disclaimer is I'm not a CPA, and so I would definitely consult your tax advisor on that, but they give me this program for a reason. And once again, here we go. Home equity debt is debt secured by qualifying residence that is not acquisition debt. But once again, HELOC, home equity line of credit, is what HELOC stands for. Proceeds used to buy, build, or substantially improve a qualifying residence equals acquisition debt. State and local taxes. Who's happy to be living in the state of Florida? Okay, can we skip this? Is that all right? Can we just skip over this? Okay.
From California.
Oh, okay. Welcome to Florida. Welcome to Florida. Yes. so you're probably happy about this section then. So interestingly enough, I will touch on this section a little bit. There's huge litigation. The states who are charging state income taxes, the problem is they did away with the deductibility of state income taxes. And so that has sent all the states who are charging state income taxes in a hissy. And basically litigation is building as we speak on battling that. But that, that's something to add to the, but here in the state of Florida, we don't have the state income taxes, so we're able to dodge that bullet. Right, I can understand. I can understand. Any other questions on that? That might switch. There we go. Standard deduction versus itemized deduction. So amounts nearly doubled for the standard deduction, and also the head of household and single filers. You also have home mortgage interest deduction, having a reduction in the availability of that because of your HELOCs and such. Welcome to graduation week. No, it's graduate. This actually was this is actually an IB awards banquet. Yeah, so International Baccalaureate program at Nice High School. Child tax credit. So it's doubled for all of you that have minor children. Raise your hand. There you go. So those who are retired and have minor children, raise your hand. Exactly. So, but we'll go over it. Child tax credit has doubled. One interesting thing that I actually learned in preparing for this workshop is refundable versus non-refundable credits. So if you actually have someone who does not qualify, it could be an adult, a dependent adult. A refundable credit is one that actually you could receive a tax refund for, and it'll be included in that tax refund check. A non-refundable credit means that if this is the difference between you receiving a refund and not receiving a refund, you're not going to get the money. Whatever that's worth. Did I say that properly?
Yes.
Okay, thank you. Here's the example of that family of five again, where the child tax credit versus the personal exemptions comes in. So because of the increased child tax credits, instead of the $32,950 in 2017, now that credit goes up to over $37,000 for that family of five. Another big thing that changed, and this definitely affects retirees, is Roth IRA recharacterizations. They have taken that off the table. So what that is a fairly sophisticated tax technique where if you converted traditional IRA funds to a Roth IRA and you suffered poor investment performance during that time, that short term, you could actually recharacterize. You could say, oops, bad time to do that, bad market time, let's move it back to a traditional IRA, and they would actually accept that. They have taken that off the table now. So once you convert to a Roth IRA, you are not allowed to go back to the traditional IRA because of bad investment timing. Some enhancements in 529 plans. You now can use these for lower level education, K through 12, public, private, or religious schools. The thing about 529 plans is you just simply have to show a qualifying expense. There's where your tax advisor comes into play again. I've seen and heard of some pretty creative stories when it comes to qualifying expenses. But also one thing that you don't hear a whole lot about is actually the ability to transfer funds to ABLE accounts. ABLE accounts are actually a little known, like a 529 type of an account, but it's specifically designated for disabled people. So if you have a disabled child and you want to save for their future, it works basically just like a Roth IRA in that you can put money in and it grows completely tax-free as long as it's used for qualifying expenses for a disabled person. So that can be a great way to save for future dollars for someone who's disabled. So everybody, I don't know why, everybody loves talking about divorces in these workshops. So alimony, not deductible by the paying spouse and not included in the recipient's income for divorces implemented after December 31st, 2018. That one of the favorite topics in my Social Security workshop was how divorcees could actually cash in on the old husband's Social Security dollars and then never know about it. That was always got a big laugh out of that. Provisions affecting business owners. So there's now a 21% flat corporate tax rate, and also there's been some tweaks to the pass-through business income deductions. So for those small business owners like S Corp, they have some additional relief. They have also kind of tweaked the bonus depreciation that is scheduled, as you see on the slide there. So the significant, I'm sure everybody's heard the story, I made too much money this year and I have to go buy a new truck. So that's part of what's falling into play here is they're kind of tweaking that law a little bit, and you're not able to take, what's that?
I thought that ended a long time ago.
No ma'am. But, well, as you can see, it's actually changing significantly now. So, when it comes to taxes, where do you go from here? We'll certainly recommend talking to a qualified tax professional. We would love to help review your tax situation. We actually use a tax efficiency software that allows us to basically take your tax return, we plug in all the different areas of your tax life, and we can show areas where you might be able to improve or tweak based on your individual circumstances. So if you have, let's say 5 different buckets, I have old 401k here, I've got some Roth money, I've got a pension, and I've got real estate income. What we can do is we can plug in all of those numbers and show where you might be able to improve your tax situation based on those different income streams. But like I promised, there's more important things than taxes in retirement, and I'd like to spend a few minutes on some really strong considerations you need to think about in retirement. They're much more critical than taxes, such as inflation. That was one of the reasons why we tore up the dollar bill was inflation, and the fact that it is vital that retirees have something going on that fights inflation. Inflation currently runs somewhere between 2 and 3%. So that means your assets, we all understand the eggs that we're buying and the cleaning supplies and everything we're buying at the grocery store, those prices don't stay the same, they go up over time. And so we need to make sure that we have something in our equation that's going up over time as well. Healthcare cost, we talked about this as well. That's one of the reasons why we tore up the dollar bill, is because healthcare costs are going up 3 times the amount of inflation. So somewhere between 7 to 9% annually, healthcare costs are going up. Huge issue. This is the single biggest issue in retirement as far as when it comes to expenses. Long-term care. Long-term care will absolutely eat away on a life savings. I was somewhat blessed. This past Sunday, I attended a memorial service for one of my dear clients. She had some serious health concerns, and it was time for her to consider a long-term care facility. She was a dear client, but I will tell you, she didn't have a lot of money, and it would have been a matter of months before her life savings would have been completely gone away. So it was really a blessing that she was able to give a certain percentage to her church and to her nephews, because those were her designated beneficiaries. But long-term care can absolutely just make a retirement equation disappear quickly. Bad investment choices, or certainly not necessarily choices, but performance over time can absolutely eat away at your retirement savings. There are definitely some considerations we're going to go over. I don't know how well you can see that.
That's better.
Unfortunately, well, here's the thing. You can tell what's up and what's down, right? Let's go over this for a second. This is the S&P 500. Everybody understand what the S&P 500 is? It's the 500 largest stocks in the United States. And this is the performance of the S&P 500 since 1980 and actually this was January, was the last time I had this chart updated. The red dots down here represent how far the market goes down in any given year. So in 1985, the market, S&P, went up 26% in 1985. Sometime during the course of the year, it was down 8%. So if you'll notice, every single year there's below the line, there's losses going on. So there's some great lessons to be learned here. First of all, do you see a cycle at all? Do you see like, oh, it goes up for a while and then it comes down. It goes up for a while and it comes down. I know I see it. So that's one thing, is that the market runs in cycles. The other thing though, and the great news is historically speaking, there's a lot more up bars than there are down bars. So patience is something that has to be exercised as well, because even though you have a down bar, if you give it enough time and enough patience, there's a lot more up bars than there are down bars. Another challenge that we're running into as financial planning community is this is actually, anybody understand or know what this is? Well, I guess, I don't know if you can read that or not. This is the 10-year treasury yields since somewhere, I think that's like 1956, if I'm not mistaken. So what this is saying is that no advisors, unless your advisor that was somewhere back here in the 70s is still operating today, has been in a generally upward moving yield environment. Every advisor who is on the planet today helping you has been in a declining yield environment. And we're pretty much at rock bottom now. And the challenge is people who, I'm sure you remember, back here, the CD rates were off the charts, right? For savers, you were getting rewarded handsomely. The problem today, savers are making nothing. And so this is a real challenge for people who are working with clients and trying to plan secure retirements. So we've got our hands full. We've got a zero interest rate environment we're working with, the lowest it's ever been, and also trying to secure a good retirement with decent income. And so we have a lot of tools that we work with to try to help this situation, but generally speaking, this is a tough problem for us as far as trying to put together portfolios and long-term plans in basically a zero interest environment. But this is one of the big challenges that we face as planners these days. Sequence of returns is absolutely vital in your portfolio and understanding how that works. If I can if you'll see here, investor A starts out with $1 million and has some fantastic market performance at the beginning, and then has some terrible market performance at the end. Investor B starts out with terrible market performance, but has the same market performance over time and has better market performance at the end. The problem is there's withdrawals being taken out this whole time, and so investor A, who had fantastic market performance at the beginning, ends up with actually more money than what they started out with. Investor B, who started out with terrible market performance, because they're making withdrawals, ends up with almost half the money.
Are they making withdrawals or are they losing it because they're bad returns?
No, they're making withdrawals as well. That's part of the challenge here. What you're seeing here is there's withdrawals being taken out as well.
So the idea is to stay on the left side and don't touch it, right?
Well, the idea actually is to have a portfolio that has a mix of things that equity building over time, but also safe investments to help pull money out, and it's not going to affect your market performance. So you go into a safer environment to draw that money out, to let that go over time. Yes, ma'am.
Is investor A taking money out also?
Oh, you know what? I take that back. They're not taking out money because of the 25%. You're correct. No, they are not taking out money. I grabbed the
So
wrong slide.
A is not, but B is.
No, neither one of them.
Oh, neither one of them.
Neither
That's
one.
just because of
That's
its
my,
short
that's my fault. I
Okay.
grabbed the wrong chart. But the thing that you do need to pay attention to is that they both make the same investment return over time. So, because you have to, I'm glad you brought that up because that's the next slide. Because the challenge with sequence of returns, you have a portfolio loss, and the greater the portfolio loss, the harder it is to get back to where you started.
Just funny because you don't have enough time.
Right. It takes more time to get back where you were. So a 10% or even a 20% loss is somewhat recoverable. Heavier losses than that, especially in retirement when you're taking withdrawals on an annual basis, are even it makes it even harder. So to recap some of these issues in retirement, certainly we have the taxes that we have to understand about. When do you plan to retire? Or are you already retired? How long should you plan for? That's an issue to understand in retirement. How much annual income? Also, how much should you be able to expect from Social Security? Between Social Security and Medicare, that represents over 50% of the federal budget. Just those two items. Have you reviewed your tax efficiency? And then those investment items that we brought up as far as inflation protection and healthcare costs, those are all considerations you need to consider in retirement, and how are you going to attack those. So here's where the advice comes in, is that part of this presentation you have the opportunity to meet with me and discuss more on a personal level the advice part, because each one of us has a different situation. Each one of us has a different set of scenarios and considerations. And so the advice part comes in that we're able to sit down and discuss what your particular issues are. And so I can offer some assistance and some guidance on ways that you can better your retirement. So part of that appointment, what will we discuss? Well, it really depends on you. We're going to discuss what you want to discuss, whether that be what does my Social Security look like, what does my portfolio look like, what is an income forecast, how's my tax efficiency, where will we meet? That certainly depends on you. I prefer meeting at my office over time, well, especially with clients. But for this meeting, for advice, we can meet at your home, we can meet at a coffee shop. Like I said, I prefer my office because all my tools are with me at my office, but we'll certainly meet wherever you want to meet. How long will it take? About an hour. I think an hour usually is a good enough time to sort out any issues or questions that you may have and be able to, at least figure out a path. Will you try to sell me anything? Absolutely not. I am not a salesperson, I'm an advisor, and I've been told by business coaches that's probably a fault of mine, but that's just kind of the nature of how I work. What will I learn? Well, it certainly depends on what we discuss. And what would be the next steps? Well, there's three choices. Either one, after further discussion, we decide that we have a common path and we can start working together and we can start laying down plans on how that would look. Two, maybe it's not the right time, and so we agree that we're gonna stay in touch and revisit with each other in the future and see when that right time may be. Or three, we decide we hate each other, we run different directions, and never see each other again. So those are the three choices. But a couple of things that we typically hear when you don't make an appointment, well, I don't have my calendar. Well, the important part of this is actually putting something down and getting some sort of appointment on the calendar, and we can work through those finer details later. I actually have my calendar available to set that appointment this evening. I want to think about all this, and I love that response because this is for those who are not taking retirement seriously enough to think about it. I don't want to work with those people. I want to work with people who want to think about it, but postponing the process and postponing that putting plans in place is not a good idea either. I already have an advisor. Well, good for you. You've at least taken some steps towards a secure retirement, but I would caution you, there's a reason why you came here tonight, because you're not getting something that you really need. And I would love the opportunity to maybe see if we can fill that gap for you. Those numbers on the right-hand side, 15 is the next 15 years, there will be over 70 million people in the United States retiring. What we know is retirement. And that's one of the challenges, is there's, in the evidence of history, there is no such thing as retirement. This is something that crazy Americans drew up about 40, 50 years ago. Before 50 years ago, there really was not anything called retirement. Monaco, Japan, and Singapore, if you look at the next line, those are the life expectancy rates of each one of those countries. So Monaco, 89.4, Japan, 85.3, and Singapore, 85.2 years is the average life expectancy in each one of those countries. The United States, 78.69. So that is a challenge, because the next line, in 1934, when FDR implemented the Social Security Act, once you hit 65, you could get a Social Security check. The only challenge was the life expectancy was 62 back then. So if you made it 3 years past life expectancy, you could get a Social Security check. Well, needless to say, we're still running on that same framework with Social Security today. The Social Security as we know it was not built what we're doing with it now. And so that's one of the fundamental flaws of our retirement system. But with planning and understanding what you have available, you can do this. This is actually a print that I purchased. Anyone want to take a guess on who the artist is on this?
Oh, yeah.
Who? I'm sorry? Norman Rockwell, right. That's unmistakable, isn't it? So I bought this print 20 years ago when I first got in the business I had no gray hair back then. A lot of children driving me crazy, gave me a lot of gray hair now. But I bought this print and had it framed and hung in my office 20 years ago because this is what I envisioned people about to enter retirement felt like. I don't know how off I was, but I can tell you I'm closer today than I was 20 years ago, and I know I feel that way now. And so I always take that in consideration, that people sitting with me, this is something that they've never done before, and they're scared, and they're concerned, and they want to make sure that they're doing the right thing. So I assure you that I want to make sure people are doing the right thing as well, and that's why I still have this print in frame today. Thank you so much for coming. I do have a form for your appointments and evaluations in the packet. I do ask that you fill those out. Any other questions that you might have? Yes, sir.
I'm surprised you didn't mention annuities tonight. To me, I'm a solid believer in annuities.
Yes, sir.
I've got 3 of them. I've got them projected for the next 30 years. They pass right to my beneficiaries.
Yes, sir.
Yes, they're taxable, but I don't have to worry about the stock market. I don't have to worry about anything. I even buy my properties, and I'm a big property investor.
Yes, sir.
I buy them out of my annuity. To me, they're the greatest thing around.
I can tell you why I didn't mention them. Because you're not everybody feels the way you do. And
Well,
so let me.
the way they're marketed, number one, can be a problem, and they're high commission on a lot of cases.
Yes, sir.
I have a no-fee annuity,
Yes, sir.
and it's the best thing going. Can you tell me what's wrong with it?
Well, so I'll be glad to answer that the best way I know how. Can I tell you what's wrong with annuity? There's certainly times where it doesn't make sense. I don't know anything about what you've purchased, so it would not be my place to talk about what you particularly have purchased. I can tell you one of the challenges with annuities today, and by the way, just so that you understand my framework, there's a reason why I am considered an independent. I have the most widely capable opportunities to work with people than anyone else that I know. I can work on a flat fee basis. I can work as what's called assets under management. I can work through product sales like annuities. So I have any and all really opportunities available to me to help clients. And that's really how I work, is I help clients and let the compensation figure its own way out through working with them. But as far as annuities in particular, one of the challenges is that annuities are built on a chassis that creates income over time. That's actually where annuity comes from, is an annual stipend. And it's actually, the original idea came from the Romans. If you had a herd of goats, but you had no money, you could go to the local constable and say, hey, listen, I've got all these goats, but I got no cash. And the constable would look at, oh, you can look at all those goats. I tell you what, you carve out about 10 of those goats and give me 10 of those goats, and I'll make sure that you have an annual stipend, annuity, to make sure that you're well covered. And so annuities, the chassis of an annuity is based on an annual income, not lump sums, and that can be a challenge depending on certain individuals' situations. You might have a situation that's not a problem for you.
Think about this. An annuity is an asset. But when I change it into an income stream, it becomes income, and it's no longer an asset.
Yes, sir.
You agree with that?
I would.
Okay. Now, I gotta go into a nursing home next month. I got $1 million in my annuity. Oh, let me see, I want $200 a month out of my annuity paid to me while I'm in the nursing home.
Yes, sir.
And guess what? Nursing home can't consider that an asset. It's income.
Yes, sir.
Nobody can sue me because it's income. To me, that's the safest thing in the world.
I follow you. Yes,
I
sir.
mean, can you think of a better strategy if you got to go in a nursing home? And that's my biggest fear.
Yeah, well, so one of the challenges is if you make too much income, the nursing home will attack the income. They can't, based on your income,
That may
That
be,
means your ability to pay. There is an income-based,
yes.
equation and
I would
calculation.
set it up where it will never work out with the nursing home.
Okay.
And actually, well,
You-
anyway.
You've done some fantastic planning, sir.
Oh, I have.
I
have.
scratched my head while you're here tonight.
I've been to the best brokers in the world and lost all kinds of money.
I got you. All right, sir.
Berkshire Hathaway, though, he's the best one, though.
Very good. Any other questions I can answer for anyone? Thank you. Have a safe drive home. My goal was to get you out before dusk, and I think I've done that. So, and my apologies for the cold weather in here.
Wish we could take it outside.
Goodness, I'm so sorry, Mr. Cole. I'm just gonna collect any papers anybody has. And I didn't shut the door because I was hoping to let some of the cold out.
I know. Sorry to get so annoyed.
Yeah, well,
Thank you
that's-
so much.
Oh, those lovely little teenagers.
I remember that.
Thank y'all for coming this evening. Hope y'all enjoyed it, got something, a little something out of it. Good.
I think I'm a little more confused than I was.
Oh, okay. Well, didn't mean to create that.
Cookies, please.
I was hoping to create some clarity.
No, there is clarity, but I also have an annuity. I thought you had to take money out once you get to a certain age on that.
Well, it depends. So you can have an annuity and an IRA plan, and you can have an annuity and a non-IRA plan.
Oh,
So it all depends on what kind of an account
so
you have.
mine was an IRA.
I'd have to look, I'd have to look at it to tell you. But it'll typically, so if it is an IRA, it should say, it should have a part of the account label, or somewhere on that statement, it should say that it's IRA funds.
I got a question for you,
Yes,
because
sir.
I think we're kind of unsure on our taxes coming up, because I retired, she's too young to take social security yet.
Right.
So we're working off, when you
No,
got
no,
social
I'm
security, you
taking
can't get
Social
that.
Okay, all right.
Somebody was telling me though I should be taking off his social security instead of mine, so I can let mine grow, cause,
Yes, there are some social security strategies.
but I already signed up for it, so I think it's too late to change it.
Sometimes, so all that has changed. There was some, several years ago, we were doing social security workshops, and there were some very liberal rules of social security. They've kind of tightened that up a little bit. So I would have to understand your situation a little bit better to fully answer that. But anyway, that's,
Well, I don't think we're gonna set an appointment now, once we're just here 2 weeks now, we're still sitting at the house.
all right. Where y'all living?
Shearwater.
Okay, well, actually, I got some of my best clients are about to move into Shearwater this week.
Really?
Yep, sure enough.
Yeah.
And I've got pension, I've got ESOP programs.
Okay.
Paying out over the years.
I got you.
It's a good deal, but
Well, very good.
I just wanna protect us in the tax side. And
Yes, sir.
we have Everard Jones with all of our investments. And I just always say Everard Jones, Everard Jones.
I know what you meant.
And
There's not that many of them.
I know, that's why, yeah.
And she happens to be licensed in Florida and
I
California,
see,
so
gotcha.
it's like,
But the tax side is where I'm a little confused.
Gotcha.
Because we're taking some withdrawals out of the first distribution and,
yeah,
yeah. Remember, we could only pay back one of them
right.
when we did the two
Right,
down
so that
payments.
was-
Yeah, we ended up buying 2 houses.
Okay, all right.
But the cost difference between California and here, it's,
It's nice.
Gotcha, gotcha.
And the property taxes.
Well, y'all have a safe drive, from, I guess, back to Shearwater from here. You gotta take 9B over there and then 295, so.
95s, shoot 10 and shoot across.
Okay, yeah, you actually, what you'll do, your easiest route is actually from, especially this time of day, is take 95 and then, new interchange 9B. If you'll take 9B, that'll take you directly to 295.
Yeah, I do that Waze and Google. and
Right,
never
Waze
get
is
there
good, Waze
except
Waze will treat you right.
So I'll leave you this one.
Okay, very good, thank you. That's-
Thank you very
We've
much.
got plenty more where that came from, so I appreciate
Have a
it.
good night.
You too.
Thank you.
Yeah, absolutely. Hope you got a little something out of it.
I know, I'm sorry, I didn't understand the, A and B thing.
That was my fault.
That makes
I,
sense.
so I changed it.
I know, I was like, good job, and I was like,
Yeah,
are you sure
I
it's a
messed that up.
distribution vehicle?
Well, unfortunately, I didn't have a whole lot of time to spend on the presentation, and I didn't evaluate it closely enough.
I wasn't trying to call you in at all, I was just
No,
trying,
no,
I was like,
it
oh, wait,
wasn't.
so this one's taken up, but this one's not,
Right,
I was just
no.
trying to under.
No, it was the sequence of returns, the fact that you had a loss,
Mhm.
and that loss recovery is so substantial.
No, that was crazy, like, at the end, they had the same
Right,
percentage,
same market
but such a big
performance.
difference of
Right.
how, I guess, so the moral of the story is you want better performance up front, because then you have more money making more money for you, so you
Moral
can take a hit.
is zero is your hero. Zero loss.
Well,
Leads
yeah,
into
but I
the
mean, you know,
ignorance.
so just showing the difference of like if you, cause obviously it's always more money makes you more money, so if you can get it in the beginning, having making more money then.
Well, and
it's
frankly,
easier.
for a retiree specifically, is the idea is to carve out something to make sure that you are, because even if you literally stick it under the mattress or stick it in the bank account at zero, that'll help, even in a bad market year, that'll help, secure that performance to some degree. And it'll also help secure your income while the rest of the portfolio recovers.
That's a good slide you have with the, over the years, of showing that every year, even though it like ended up here, that every year there was always a
Oh, that
loss
is,
period.
that's one of my
It's a
favorites.
good slide because it shows people that, okay, even though this week was bad,
Right.
in the end